Hello and welcome to 5-Year Club video number avocado. Wait, no. Video number 110. Avocado. Second half of avocado. Where Lewis eats an avocado. That's right, that's all we're doing today. Eating this avocado. Covered with one of my favorite seasonings, Trader Joe's South African Smoke. Tonight we are going to talk about asset allocation. So thrilling, such an engaging topic, asset allocation. The reason why I decided to do this today is because someone on Facebook, on a group that I follow, was wondering what his father should do with his retirement portfolio. And, I suggested, you could do 20% bonds, 80% stocks, but hey, maybe you just want to do 50-50. And I decided it was best to just give this guy the tools to look at the numbers himself and make a decision, rather than to say something really concrete. His father was in a pretty good position in terms of having rental property income and an emergency fund and things like that, so sounded like a complex situation, and there's no point weighing in when you don't even know how much someone's spending is. But I thought it would be useful to give that guy a calculator, so I searched for one on Google, one that would calculate this asset allocation thing and the differences, and I found one, and then I was like, wait, this calculator actually has a lot of interesting stuff, a lot more stuff than I was looking for, and it would be really fun to share it with my loyal viewers. So that's what we're going to look at tonight. Let's talk about some basics first. Let's just talk about basically what is asset allocation and what is annual rebalancing. Well, asset allocation is a simple concept. It just means, where do you want your net worth to be? What do you want your net worth to be? Do you want it to be real estate? Do you want to own a bunch of real estate? Do you want to own a bunch of companies? Do you want to own half real estate and half companies? Do you want to own half real estate and 30% companies and 20% bonds? And asset allocation, generally speaking, says that ahead of time you're going to decide what form your net worth is going to take, like what proportions your net worth is going to be in which categories. And then you're going to just fix that at a number. So you're going to say, I want to be 50% stocks, 50% bonds. And that's what I want my net worth to be forever. Or you could say, I want my net worth to be 100% stocks until I get to be say age 60. And then every year I'm going to decrease the percentage of stocks by 5%. So that by the time I reach age 70, I'm at 50% stocks and 50% bonds. Maybe something like that, right? So that would decrease the volatility in your portfolio at a time in your life where maybe you statistically had 10 years more left to live. I don't know. Maybe it's worth it to have less volatility because you're concerned that you're going to dip into your portfolio and you don't want there to be a recession and then not have the money you need to pay for medical care. Very important for me to point out right now that there are ways of handling problems like medical care specifically, such as long-term care insurance, that you can and should have in place outside of this whole discussion of asset allocation in net worth. And by having those insurances in place, by having those lifestyle things in place, you're going to give yourself more flexibility in your investments. So they're not completely separate in the sense that you want to responsibly take care of your insurance so that you can pursue more aggressive investing strategies than you otherwise might. If you are already very old, long-term care insurance would be very expensive, and it may be so expensive that it's not worth buying. And in that case, you may want to go more conservative on your portfolio because you did not buy that insurance at age, I guess it was like 61 or 62 that Dave Ramsey recommends, because statistically most people don't need it before then. All right, and so that is asset allocation. It's just deciding what categories and what percentages your net worth is going to live and grow in. And annual rebalancing is simply looking once a year at how much of each category your net worth currently is, and then buying and selling things so that you adjust the portfolio back to the allocation that you planned on in the beginning. So for example, if stocks have a very, very good year and bonds do not have a very good year, and your portfolio was 80% stocks and 20% bonds at the beginning of the year, it's very possible that at the end of that year, your portfolio may be 85% stocks and only 15% bonds. And in that case, you would sell some stocks, buy some bonds until your allocation was again 80% stocks, 20% bonds. What this is going to do is during really good years, you're going to sell off some of those gains and buy bonds. And then during very bad years for the stock market, you're going to see, oh, those stock prices have gotten very low. I'm going to sell off some of my bonds and buy those cheap stocks with the proceeds from the bond sale, and get back to that 80%, 20%. And this is the mechanism. The annual rebalancing is the mechanism that we use to smooth out our investment performance over time. And asset allocation, beyond its actual meaning, has a special meaning for me because it was part of the name of the first mutual fund I ever owned. When I was growing up, my mom decided to introduce me to investing, and she introduced me to the concept of mutual funds and gave me $1,000, but said, well, she didn't literally give me $1,000. She, on paper, gave me $1,000 and then said, you're going to invest this money, and it's up to you to decide what investment you want to pick. And you need to pick it from this prospectus. Well, what the hell is a prospectus? Maybe the prospectus is something that like a doctor uses. You go into the office and he's like, bend over, sonny. I'm going to use my prospectus. No, turns out that's not what a prospectus is, thankfully. A prospectus is a formal legal document that is required by and filed with the Securities and Exchange Commission that provides details about an investment offering for sale to the public. So every mutual fund has to have a prospectus that has a standard set of information about that mutual fund so that investors can make responsible decisions about what they want to buy, and they can kind of do apples to apples comparison between mutual funds, for example. And the prospectus contains a lot of different information. I believe this is a prospectus or something like a prospectus for value line asset allocation. And it is going to include, the performance over time. It's going to include the top holdings. So what are the companies that this mutual fund is invested in, and also the top bond holdings. What are the debt instruments that this company is invested in? What general industry sectors is this mutual fund holding? Dividend information and capital gains. So yeah, a lot of information, a lot of numbers, and definitely hard for someone. Maybe I was 12. Maybe I was a teenager. It was somewhere in that range. Difficult to figure out what's going on. But even back then, you can look at these graphs for the different investment options, and you can be like, this graph goes up more than the others. I'm going to invest in this, which I'm sure is exactly what I did when I picked value line asset allocation. And so I just pulled this from the portfolio. Value line asset allocation holds about 68% stocks, 26.95% bonds, and 5.18% cash. And it looks like I got that directly from the Value Line website. And I always like to know who are the people managing this. So we are going to read the bio of Mr. Stephen E. Grant. Stephen E. Grant has been a portfolio manager with the Value Line funds since 1991. Over the past 20 years, Mr. Grant's unique quantitative behavioral methodology has driven the success of several equity and hybrid funds. This disciplined investment strategy concentrates on high-quality companies that have superior and consistent long-term records of growth in both earnings and stock prices. Wide diversification limits exposure to any single economic sector, and the resulting smaller-sized holdings also means that laggards can easily be replaced by stocks showing superior momentum. Mr. Grant and the funds he manages have been recognized by publications such as Barron's and Kiplinger's and included in the Wall Street Journal's Category Kings. Mr. Grant has a BA in economics from Stanford University and an MBA in finance from the Wharton School of the University of Pennsylvania. A very pedigreed man. A degree in economics from Stanford, I believe that runs a price tag these days of about $240,000. And an MBA in finance from Wharton, I believe that's going to be $100 to $200. I haven't looked up business degree costs recently, but we're talking about a man with over $250,000 of education in today's prices, graduate school, a long track record. He's able to buy the good ones. He's able to sell the bad ones. He's wearing a suit. His brain is so powerful it burned off his hair. Oh, I wish I was as talented as Mr. Stephen E. Grant. So let's look at Mr. Stephen E. Grant's handiwork here with Value Line Asset Allocation. What I did is I used this portfolio backtester. So what you can do with this guy is you can set a range of a number of years and set an initial investment amount, and then you can pick different, let's just expand this a little bit so the UI is a little bit easier to see. Oh, shrink myself. Yeah. So what you can do is you can pick something like VTSAX, which is the Vanguard Total Stock Market Index Fund. And you could say the first portfolio that I want to look at is just going to hold the entire stock market. That's what VTSAX is, right? And then the second portfolio, let's pick up something else here. So VBTLX, Vanguard Total Bond Market Index. Okay, so this is like a bond portfolio, right? So you can put in that there. So portfolio number 1 has nothing but stocks, and portfolio number 2 has nothing but bonds. They rebalance annually. Turns out that there will not be any rebalancing here because they only hold one category of assets, so there will never be anything to rebalance. But what you can do is put in these numbers and pick your the things you want to compare. And let's just pick something random at the end. They have these popular portfolios that are talked about in investment books, and if you want to, you can pick them. So I haven't even done this yet, but Bill Bernstein no-brainer. Oh no, coffee house. Bill, that sounds interesting. A coffee house one. Bill, some guy's name, and then coffee house. I don't know what this is. Maybe it's in a book somewhere, but that's going to be our third portfolio. So our first one is the entire stock market according to Vanguard. Second one is the entire bond market according to Vanguard. And the third one is some dude at a coffee house. And you can click Analyze Portfolios, right? So now it's going to show us our allocation for each of them. The first one is just the total stock market. Second one's the total bond market. And the third one is a bunch of crap somebody said at a coffee house. All right. And these are also all Vanguard funds, apparently. This guy likes Vanguard too. Yeah, Vanguard's pretty popular, turns out. And then it's going to give us the final results of these. So we can see that the total stock market gave you $34,000 if you invested $10,000. The bond market gave you only $20,000, so you missed out on $14,000. And then the coffee house guy did worse than the stock market average, $31,000 for his picks. And here we have, what these were. And so you can see the characteristics of them over time. The blue one is going to be the total stock market. So you can see in the 2008 crash, it got creamed more than any of the others. But then afterwards, it accelerated, to the moon and beat everybody. The coffee shop guy was winning kind of in the middle, and he kept going up. But more recently, he has lagged the stock market. And the bond market has been in the bottom the whole time. And as of right now, it is like severely behind. You missed out on $14,000. It is, it's not doing too well. So that's what this calculator does. And so what I did is, let's shrink this back down. Make myself huge again. Huge. I picked, for my first portfolio, I picked the Value Line Fund. Yeah, right here. And then for the second one, I was like, well, Value Line Fund's like 68% stocks. Let's just call that 70%. And then I don't want to mess with cash because I don't actually know the symbol to put in for cash. I should, but I don't. And let's just say 30%. So 70 plus 30 is 100%. So 70% stocks, 30% bonds, according to Vanguard. These are the total market indexes. That's what we're comparing this to. So portfolio number one is Value Line Asset Allocation, Mr. Stephen E. Grant's life's work. What he got his fancy degrees to put together, where he picks the good ones and sells the bad ones and rides a unicorn into the sunset. And second one is just, Lewis screwing around. Well, they look very similar, don't they? And in fact, Lewis's screwing around happens to be the winner at the moment. So, what the hell? Yeah, turns out this guy's MBA and his Stanford degree don't mean jack. And he's not actually good at picking stocks, because if you just follow the entire market, the entire stock market, the entire bond market, with roughly his allocation of assets, 70-30, you get about the same thing. So the fact that his fund did this was really not a function of his selections. It was really a function of just the fact that he picked around 70% stocks and he picked around 30% bonds. Oops. And now I want to focus on the stock bond question. And I want to do that by comparing a portfolio of nothing but bonds to a portfolio of half stocks and half bonds to a portfolio of pure stocks. And let's just look at how this portfolio works over time. So this is all Vanguard stuff. This is none of the private crap like the Value Line Fund. So all of these things might have a place in your portfolio. And this is what we see. We can see that the bond fund, it avoids the dips for sure in the beginning. But after, 16 years, I guess, it is fallen behind these others in a pretty dramatic way. And the middle portfolio, the 50-50, falls in between them. And then the total stock market portfolio is the clear winner after around 16 years. But you can see that because of the 2000 tech crash and because of the 2008 stock market crash, the pure equity portfolio does dip below the other two at times. That's going to be more difficult now that it has outpaced, because remember, they started even. Now they're not starting even if you were looking at the following 16-year period. So the pure equity portfolio, to some extent, has kind of like earned its keep. So it's going to be more difficult for it to fall below the other two, just because the other two are lagging and will continue to lag so far below it. But it is important to show that the winner, the long-term winner, is also somebody who likes moving around a lot. And that's what we mean when we talk about volatility of stocks. The next one I wanted to look at is the David Swensen lazy portfolio. Not only because I'm lazy, but also because David Swensen wrote an interesting book called Unconventional Success, A Fundamental Approach to Personal Investment. He manages Yale's endowment investing, and Yale's endowment has done quite well. I've read about 2/3 of this book. I think it's a very, very good description of different types of asset classes and why you should or should not invest in them. For many people, it will be too technical. If you're an engineer, it will not be too technical. But if you do not want to read about the details of why municipal bonds and corporate bonds are different, then this book is likely not for you, because he does go into detail about those things. And so you can find at the link I'm going to put in the description, David Swinson's Lazy Portfolio is one of the options. And I wanted to compare it to Value Line Asset Allocation. How's this guy doing versus Mr. Fancy Pants Investor up there? I also recommend this book, and I'm going to put a link to it in the description. And what we find is that Swinson's portfolio totally demolishes Value Line Asset Allocation. Let's dive into what Swinson's portfolio is for a moment. I think that's important. First, I'm going to start with the most conservative things in his portfolio. Vanguard short-term treasury. So these are treasuries, which generally don't do as well as bonds. And Vanguard inflation-protected securities. So there's something that's relatively new called inflation-protected securities that you can buy, and the government adjusts them with inflation over time. So you can be sure that if you put your money in these inflation-protected securities, that you will not be overtaken by inflation like you would if you purchased some bonds in certain historical situations. So it's protection against inflation, but you're also not going to get the amazing returns of the stock market. So what does that mean? It means that 30% of Swinson's portfolio is something like a bond. It's a fixed return security, a fixed, I forgot the name of it, but it's not an equity. It's something more like a bond. And this is not too different from Value Line Asset Allocation. Around 30% fixed return securities in Value Line Asset Allocation. What else is in Swinson's portfolio? Well, one, it's Vanguard funds, so in general they're going to charge lower fees. Two, these are index funds, not privately managed funds. So there's no one picking stocks in these funds. They just have programmed rules on how the assets are selected, whether that is the top companies in a certain sector by size of the company or whatever it is. And what these holdings are a total stock market index. That's what VTSAX is. VTSAX is it holds very similar stuff to Vanguard's VTI, which is the exchange traded fund form of the same thing, and VTSAX, which is the Admiral shares form of the same thing. So 30% is in a total stock market index. 20% is in a real estate index. Okay, that's something we haven't talked about much, and that's a little bit different. Real estate has performance that is in between bonds and stocks, but a little bit closer to stocks. So it has some of the same characteristics as stocks and bonds. The rent that you get from the people occupying the property is more like a bond. It's a regular payment that you receive. The value of the property itself is more like a stock, because it is protected against inflation, because the value of properties is going to go up as a currency is inflated. So 30% in the total market, 20% in real estate, 15% in developed markets. Well, what developed market means is international. So it's international developed markets, but it's international countries that are wealthy. So I would expect Great Britain, France, Japan, developed first world markets. 5% in emerging markets. So I would expect emerging markets to be maybe Southeast Asia, perhaps China, Vietnam, countries that are not considered as developed and stable as the first world, but are showing strong economic growth recently. All of these are equity-like investments. So he has about 70% in equity-like investments, 30% in bonds. So the overall split is similar to these. The difference between them is The one that is winning so much has diversification into real estate that the first portfolio does not have, and it's also invested in Vanguard funds, which don't have management fees, trading costs, and taxes that are high in private funds. So those are the differences there. And this is good job, David Swenson. Your suggestion seems to be doing very well. This intrigues me. I would not regret having my portfolio arranged this way, and I very well might open up a Vanguard account and arrange my stuff this way outside of Betterment. All right, and let's just do a final little comparison. Swenson versus VTSAX. So if we took Swenson's portfolio and we compared its returns to the Vanguard Total Stock Market Index, well, I had no idea how this was going to turn out, but apparently Swenson's fund beats the Total Stock Market Index most of the time, and then only recently, after this recent aggressive rally, they have come back together. And so it turns out that whether you did that fancy Yale guys stuff since year 2001 or whether you just stuck it in the entire stock market, as of like right now-ish, you would have done about the same. Now, all of those, 17 years in between, you would have been sitting pretty had you followed Swenson's advice. So I can't read anything into this at all. I don't know what it means. I think I'm more comfortable with Swenson's portfolio just because it has that diversification into real estate. But it shows you that the stock market isn't too shabby. Or maybe it shows you that the stock market is inflated relative to these other asset types that Swenson's portfolio was holding. Could be that too. All right, and then the final thing I want to do, is this the final thing? Maybe not. Yeah, it is the final thing. Okay, I want to compare the long-term returns if you invested $500,000, and I wanted to focus on a total stock market index versus half stock, half bonds. So this is kind of like just sticking it all in the stock market versus more traditional advice of half stock and half bonds. And if you had done this in the long run, starting from the year 2002, according to the performance right now, in the total stock portfolio, you'd have 1.736 million, and in the half and half portfolio, you'd have 1.4 million. So you would have missed out on $330,000-ish because you wanted to hold those bonds. So you really have to ask yourself, like, is it worth it to do that? And because it's really easy to hold one of these more conservative portfolios and to think like, oh, I'm safe. If they actually forced you to write out the check for $330,000 and hand it to somebody and be like, this is what you paid, it would be a lot more painful. A lot of this opportunity cost stuff is hidden by the people promoting and selling this stuff. And so it's not as psychologically painful as it would be if you had to actually recognize the money leaving. And what I did after that is I just added a third line for an 80-20 portfolio. So the blue line is going to be 100% stocks. The red line is going to be 50% stocks, 50% bonds. And the yellow line is going to be 80% stocks, 20% bonds. So more aggressive on stocks, but it still has some bonds in there, 20%. You still have a good, with a $500,000 portfolio, you would have started out with $100,000 in bonds that you could sell when the market was low and hold on to your equities. And we can see that it does pretty well. It doesn't beat the full stock portfolio, but it also doesn't fall as much as the full stock portfolio during that 2008 crash. So it comes in between the two. That's what we would expect. That's how rebalancing works. Final words. I'm going to post the link in the description. Play with the calculator. Look at different portfolio types. If you have a question about a particular mutual fund or a particular investment, just plug it in there, compare it against VTSAX, see how it's doing. Go look up the prospectus on Google, see what mix of stocks and bonds that fund has, and just start learning more about who is winning in the long run and what you own and what you think you want to own and why. And also, just based on what I've shown today, it appears that these Vanguard funds are doing pretty darn well compared to the other stuff, so I would recommend that no matter what you want to be in, bonds or real estate or stocks, it's a good idea to do it at Vanguard and open an account there, and then pick an allocation you understand. If you don't understand the real estate allocation, skip it. Go with just stocks and bonds. And if you don't understand bonds, then go with stocks. I wouldn't suggest going with bonds for a 20-year portfolio because I think you're going to lose a lot of money. And that's that. All right, thank you for joining me for video number 110 of the 5-Year Club. I'm going to go eat my avocado now while this video uploads. It's going to be delicious. I like it when the salt causes the avocado to sweat a little bit. Sweaty avocado. All right, that's it. Have a fabulous evening.